Hello, this is James Tarkenton, the Senior Portfolio Manager at Townsend Asset Management. This is an abbreviated presentation of our Capital Markets Seminar held on January 24th. To view the full list of slides, they can be found on our website, www.assetmgr.com. We will give an economic update and discuss rates and inflation, U.S. bond and stock markets, foreign markets, and discuss recent accelerated volatility and recoveries. This is a view of various business cycles over the years and shows cumulative GDP growth over each time frame. While true this has been the longest cycle on record, it is also true that it has been the most muted and steady. Many factors have contributed to the lower growth. Length alone does not suggest an end. Here, looking at the far right, you can see the more muted yet consistent quarterly GDP growth of this cycle compared to the 2.8% average we have experienced over the long term. You can also see the second quarter 2009 bottom of negative 8.4% experienced during the financial crisis. The consolidated basket of leading economic indicators continues to show expansion and the strength in the U.S. economy. It is interesting to point out that the indicator turns negative several months before a recession. The fundamental truth is that the equity markets follow corporate earnings. While there may be short periods of dislocation, the general path to the market follows the path of earnings. That should be your focus. This is the trailing 12-month earnings growth rate for the S&P 500. The recent accelerated rates support the market's higher levels. The question is obviously what that growth rate will be going forward with various global and geopolitical pressures. Current estimates for 2019 suggest continued growth, but at lower rates. As we shift our focus to interest rates, this shows the Consumer Price Index over time. The CPI is used as a measure of estimated inflation. On the far right, you can see we are at roughly 2% currently. This is an historical federal funds rate. Given where we have been, I think it's hard for some to remember that we had a 5.25% rate back in 2006. We have had steady increases lately, but the Fed's most recent comments suggest we will see a pause now and maybe not even one increase in 2019. The goal is to have a rate that facilitates stable inflation and full employment. Here we have the Treasury yield curve, both 1 year ago and today. You can see the current curve is much flatter, given Fed rate increases on the short end. Yield curve flattening and inverting has historically indicated the later stages of a business cycle. An inverted yield curve, the 10-year rate lower than the 2-year rate, has historically been used as a predictor of future recessions. Extending that point, here is the relationship of the 10-year to the 2-year since 2012. As you can see, the spread between the two rates has tightened given recent volatility. The cycle average for the 10-year is 2.52% and 0.87% for the 2-year for a 1.65 percentage point spread or 165 basis points. This is essentially an index of that spread over time. As the slope becomes positive, the spread between the two rates is increasing, and vice versa for a negative slope, as you can see on the far right. Here we have bond yields by bond ratings. Typically, a lower rated bond requires a higher yield to increase investor appetite. With spreads tightening, those searching for yield have had to increase credit risk to achieve it. Stock market performance over the medium term has been attractive, though higher volatility and questions about global growth and rates erased earlier gains made in 2018. Concerns of China trade war could continue to escalate volatility, but the market has recovered nicely year to date. Also, market valuations are not overly expensive on a historical basis or when considering past bubbles. This is a time to be selective, knowing what you own and aligning yourself with high-quality companies. The U.S. markets have performed better than either developed non-U.S. or emerging markets. There are significant benefits over the long term to staying diversified across global markets. For those contrarian investors, it may be worth considering allocating more to these markets while they have underperformed. One additional consideration would be valuation. Given greater risk profiles, non-US markets have historically traded at cheaper valuations than the US market. One thing to consider would be relative valuations across geographical markets. Sector performance over the past year has varied and reflects the risk-on, risk-off mentality of the market through 2018. When utilities, real estate, and healthcare are leading, that typically suggests fear and/or investors' desire for comfort and income. Given our yield discussions a few minutes ago, this has been an area where yield investors have allocated capital in the equity market for fixed income-like securities. As we look at 2019 year-to-date, you can see how the sector performance has reversed. Interestingly, when thinking of just 1 month of trading, you can see the large spread between the peak return and the trough return for the year. When considering market returns, you always must consider earnings growth and valuations. On a sector basis, this shows estimated earnings growth by the bar graph and PE ratios by each sector. While the overall market is not necessarily cheap, trading at its historical average multiple, there are opportunities within sectors to find attractive investments. The VIX index is used to measure near-term market volatility. While it has come down recently, you can see the spike on the far right for year-end 2018. While volatility has increased, it is not far off from historical averages. This slide shows annual total returns in a given year and the maximum decline during that year. It is important to remember that while most of the annual returns are positive, you can have attention-getting declines in any given year while earning that year's return. Here we show the number of 5% pullbacks that have occurred in each year. The stock market is inherently volatile. Still, over the long term, stocks are the best way to protect and create wealth. Staying invested is an important discipline. Here we highlight the importance of staying invested. This shows the impact of missing the best market days over the past 25 years. Fully invested over that time frame, a $1,000 investment generated $5,816. Each subsequent value correlates to the specific number of best days missed by pulling the money out before getting back in. Ironically, over the past 25 years, if you had missed the best 40 days over that time frame, that is 6,250 total market days. Your $1,000 investment would be $806. To finish things, this is a similar slide, but considering a 2% drop and staying out of the market for various time periods. Over the past 25 years, a $5,816 fully invested portfolio becomes $2,277 if you stayed out of the market for a month after each 2% drop. More than a 50% drop in the return. Thank you for listening. Should you have any questions, please contact us at 919-782-9689. Have a great day.